Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, how is stock trading different than stock investing? Answer by Laurent Burnett. Ownership defines investors. It is about time we admitted we all are speculators, from the Latin speculare, observe, examine. Introduction. A few weeks ago, I was accused of confusing investing and trading by somebody who ironically does not have sufficient experience to qualify as either an investor or a trader. Good distinction though, so here is my simple opinion of the fallacy of time horizon. Most people think of investment horizon as the primary difference between investors and traders. Investors buy good companies and hold them to infinity and beyond. In the process, they often look down upon traders, speculators and all those lesser creatures who are here for a quicker buck. The irony is many money-losing investors would still take the moral high ground over profitable traders. Is time horizon really the determining factor or just a convenient marketing excuse? Enter Mike Tyson. Everybody's got a plan until they get punched in the teeth. Everybody is an investor until they lose 20%. Throw in an old-school bear market and you'd be surprised to see how few investors are still left holding stocks for the long run. Investors own, the rest of us we just speculate. No one disputes that Warren Buffett is an investor. He only buys businesses he can understand. He thinks as a business owner first and that enables him to hold them ad perpetuum. That is his true margin of safety. Think about it at your own level. Someone came up to you with a business idea. You stepped into their shoes. You asked the tough, the real, the uncomfortable questions. You behaved as if you owned that business. You wanted to know what could go wrong. Warren Buffett is no different, just in a different league. Now compare this with professional investors who read a couple of broker reports, drink top management Kool-Aid over some fine dining, but never even bother to read through the notes to the financial statements. Understanding the inventory, receivables, payables, cash flow, investment cycles, that is so operational, so far beneath the vision investors get drunk on. For example, by his own admission before a Senate hearing, Bill Ackman did not know what he was getting into with Valeant. So, are you really an investor then? Do you really own the blunders of the companies you invested in? Do you live and breathe them? Most likely no, and you know what? That's fine. No one does. We are all speculators, traders, speculators, day traders, high-frequency traders, value investors, momentum traders, market makers, position traders, swing traders and even short sellers. Hey, can I have a child seat at the adults table please? Those are just labels, boxes, limiting beliefs. Don't let time horizon be your excuse for failure. Time is not an investment horizon. Time is what separates those who make money from those who make excuses. Soros, Paul Tudor Jones, William Eckhart, Ed Thorpe, they are labeled as traders and they are billionaires. Meanwhile, all the talking heads on CNBC who call themselves investors live, comfortably, from paycheck to paycheck. In the end, we are all speculators. Conclusion. A few years ago, as Apple share price was going down owing to Steve Jobs' health report, I was trying to persuade an acquaintance over a pricey but highly forgettable Californian cab saft to take some profit. He reminded me of my status. I am just a trader. He is an investor. He could see past the current volatility and would probably buy some more. 1 year later, same setting, when I asked again about Apple, he said he had sold the stock. So, please don't let time horizon get in the way of your investment returns. Answer by Mahi Raghuvanshi. In market there are so many investor or trader who follow different strategies like intraday trading and positional trading. In equity market the participants who want to receive long-term benefit of market known as investor who buy the stock or purchase the IPO and hold it as long as he want until the price that stock doesn't reach to his highest expected level. While a trader receives the short-term benefit of market that may be for intraday through buy today and sell today or through sell today and buy today. Intraday trading is working pattern where an investor and trader work only for a day, like if he has buy a share on today, will sell it on today itself. In real trading platform in intraday trading you receive a exposure from your broker. That depend on your creditability. In intraday trading, a trader wants to receive a short-term benefit from the market by working with proper fundamental as well as technical analysis. Stop loss is something like that could be minimize your losses or that could be limit your loss in worst or opposite condition. While positional trading is something when an individual want to hold or accept the delivery of stock in positional trading, broker doesn't provide any exposure or limit to their client. The term that you have mentioned, MES and CNC, are the some application that are mostly used for placing order of buying and selling during market hour. MES means marginal intraday square off, that is used for placing the order for intraday where you got some exposure as well. The positional will automatic squat or off till 3:30 in market hours, while CNC is another application that is used to place the order for positional. Here you can hold the position as long as you want. In CNC, position broker also focus on you mark to margin. If it goes negative, then you have to increase the investment to hold that position when it in loss. Ways to capital. Stock market tips, free share tips, stock tips. Answer by Ram Krishnaswamy. I have answered this at least on 2 different occasions, and one can search for that. But let me do it yet again. A majority of people will give answers related to holding period. If you hold it for more than period, 6 months, 12 months, etc., then it becomes investing. Wrong. The fundamental difference is this. In investing, the stock is purchased and essentially held forever, or at least for a very long period of time. The return on investment in the case of investing is via dividends, which keeps on increasing as profits are generated and distributed by a greater quantity of stock through splits, bonus, etc. In trading, a stock is bought basically to exploit the rise in its price by selling it for a greater price and profiting from that. Return on money put into the stock is via speculative capital gains. That does not mean the investor is not looking capital gain in the stock by a greater quantity and price. But the primary focus for returns is on distribution of profits via dividends mainly. This takes away the focus from holding period, which is a random number from 1 month to 36 months depending on our whim, and switches it to type of return. Summary. Investing focuses on return through distribution of profit mainly in terms of dividends. Holding period usually is very long or technically forever. I know of people holding Tata Steel for several decades and still holding them. I myself hold some stocks ever since I started investing, including the first stocks I bought in the market, 200 Aryaman sugars for 16 rupees from Jagirdar & Co. in Bangalore in the mid-80s, and several other stocks all from the good old Bangalore Stock Exchange. To give an idea, taking the high of 2,570 in 2017, CAGR on CG is nearly 18% and dividend itself is around 11 times the price I paid for the share. Dividend itself is a 12-bagger, giving a CAGR of 8%, most of it tax-free. So, a combined CAGR of 26% over more than 30 years is remarkable, especially since the company was never seen to be a blockbuster stock. Trading focuses on returns through selling at a higher price, resulting in speculative profits via capital gains, usually short-term CG, since hardly any trader holds for more than a few months. The 12-month rule used to demarcate between investing and trading has more to do with tax laws applicable, LT or STCG, and is not the basis for deciding investing or trading/speculating.